Welcome to the Deep Dive. I'm your host, and today we are stripping away the noise and getting straight to the signal of earnings season.
Yes, we are.
It's Saturday, January 24th, 2026. The markets are closed, the coffee is brewing, and we are looking back at a Thursday evening earnings call that really has the financial sector buzzing.
It sure does.
We are doing a deep dive into SLM Corporation, better known to the world as Sallie Mae.
And if you were watching the tape after hours on Thursday, you saw a move that really defies the typical logic of a transition year announcement.
It really does. So let's set the scene for everyone listening. We're reviewing the Q4 2025 call. That was on the evening of January 22nd. The stock closed the regular session at what, $26.70?
Right. And then the numbers hit.
The conference call kicked off, and the stock popped roughly 7.5% in after-hours trading, hovering right around $28.70.
Which is a significant move for astute lender, especially considering the guidance they gave for the upcoming year wasn't exactly a straight line up.
Right. And that's what we need to unpack. Usually, when a company guides for a drop in earnings per share for the next 12 months, the algo traders sell first and ask questions later.
They hit the button.
Here, we saw the complete opposite. It feels like the market is finally analyzing the structural pivot rather than just the next quarter's EPS.
I think that's the correct read. This wasn't just a simple earnings beat. It was effectively a capital and policy reset for the company.
A reset.
The market is looking past a guided earnings dip in 2026 because they are buying into a massive long-term growth story involving private credit and federal policy changes.
Before we get into that strategic shift, which involves KKR and some very interesting government reform, we have to look at the scoreboard. I went through the release, and the headline numbers were undeniably strong.
Yeah, they were.
SLM delivered $1.12 in GAAP EPS.
And to put that $1.12 in perspective, the consensus on the street, the average of all the analyst estimates, was looking for something in the 94 to 95 cent range.
So a huge beat.
So they didn't just beat, they crushed the estimate by 17 or 18 cents.
That is a substantial beat. And looking at the revenue side, net interest income, or NII, came in at $377 million.
Which is up 4% year over year.
Yeah, and I also noticed their net interest margin expanded to 5.21%. So operationally, the core engine of lending money and collecting interest is humming.
It is humming, but, and there is always a but in bank earnings when you see a beat of that magnitude. We have to talk about the quality of those earnings.
Okay.
It wasn't purely driven by interest income. There was a very specific anomaly in the provision for credit losses that contributed to that EPS number.
I caught that in the notes, and I actually had to double check the sign on the number. They posted a negative provision.
Yeah.
Usually a bank records a positive expense to set aside money for bad loans. Sallie Mae posted a negative $19 million provision.
Exactly. Compare that to last year in the same quarter, where they had a $108 million expense in that line item. That is a massive swing, over a $100 million difference in profit, just from that one accounting line.
So for the listener who might think this implies credit risk suddenly evaporated, that's not what happened, right? We didn't see borrower defaults drop to zero overnight.
No, absolutely not. This wasn't magic, it was mechanics. This negative provision was driven by releasing reserves tied to loan sales. When a bank holds a loan, they're required to hold capital reserves against it in case it goes bad. Sallie Mae sold a $1 billion seasoned loan portfolio and selected a large chunk of 2025 peak season loans for their new strategic partnership.
Right, so the logic is if you sell the loan to someone else, you don't need to hold the rainy day fund for it anymore.
Precisely. You release those reserves back into the income statement as profit. So while it helps the EPS number for Q4, it's an accounting benefit from cleaning up the balance sheet, not a signal that credit quality fundamentally shifted.
Speaking of cleaning up the balance sheet, let's talk about capital returns. They announced a fresh $500 million share repurchase authorization with a 2-year window.
Yep.
But what really stood out to me was the long-term trend. I looked back at the data. Since 2020, Sallie Mae has reduced their shares outstanding by 55%.
It is an incredibly aggressive strategy. I mean, they are cannibalizing their own float. When you reduce the share count by more than half in 5 years, you are mathematically forcing earnings per share up, even if net income stays flat.
Sure.
It shows that management believes the stock is significantly undervalued relative to its intrinsic potential.
And that intrinsic potential is what the second half of this call was all about. This wasn't just business as usual. They are fundamentally changing how they operate with this evolve strategy.
Right.
It seems like they're trying to transition from a traditional bank to something that looks a lot more like a fintech originator.
That's the key shift. Historically, Sallie Mae was a balance sheet bank. They originate loans, hold them, collect interest, and hold the bag if the borrower defaults.
The old model.
The old model. Now, they are moving toward a capital light model. The headline here is the inaugural private credit strategic partnership, specifically involving KKR.
And this is where the capital light concept needs some explaining. Because in banking, capital is expensive. If I understand this correctly, by partnering with KKR, Sallie Mae originates the loan, but KKR provides the funding.
In essence, yes. Think about return on equity, or ROE. If Sallie Mae keeps a loan on its books, they have to tie up their own equity capital to support that asset for 10 or 15 years.
And that capital is stuck.
That capital is stuck. But if they sell the loan to KKR immediately after origination, they get their capital back instantly, plus a fee. They can then take that same dollar of capital and lend it out again.
It increases the velocity of their money. They can originate more volume without needing to raise more equity.
Correct. Management stated that going forward, roughly 30 to 40% of their originations will flow to these partners. And importantly, management noted there are no clawbacks.
I circled that 3 times in the transcript. No clawbacks.
It's crucial. It means if those loans go bad 2 years from now, the buyer, KKR, or whomever, cannot come back to Sallie Mae and demand a refund. The credit risk is fully transferred.
So Sallie Mae gets to keep the relationship with the student, they service the loan, they get the fee, but they don't hold the long-term default risk on that portion of the portfolio.
Exactly.
It sounds great for the business model, but it does make the financial statements incredibly messy to read.
Oh, totally.
Management released an entire appendix just to explain the math because this strategy distorts their metrics.
It creates a denominator problem.
Right. Let's try to visualize this. Imagine a classroom of students. You have the fresh-faced freshmen who haven't had time to get into trouble yet, and you have the seniors who've been around for a few years.
Okay.
Naturally, the seniors are the ones who might be missing assignments, or in this case, payments.
That's a good analogy. Under this new model, Sallie Mae is selling the freshmen, the new performing loans, to KKR. So those loans leave the balance sheet. What's left behind?
The seniors, the older loans.
Exactly. The held-for-investment portfolio becomes concentrated with older loans. Older loans naturally have higher delinquency rates just because they've had more time to season. So if you look at Sallie Mae's delinquency percentage, it's going to mathematically tick up because you remove the denominator of fresh, perfect loans.
So the percentage looks worse, even if the actual performance of the borrowers hasn't changed at all. It's an optical illusion caused by the math of the loan sale.
Precisely. And that is why management had to spend so much time on the call explaining it. Retail investors, and even some algorithms, might see delinquencies up and hit the sell button, not realizing it's just a function of the mix shift.
Okay, so that's the internal pivot. But there's an external catalyst that I think is even bigger. We have to talk about the government policy change regarding Grad PLUS loans.
Yeah.
Management called this a once-in-a-lifetime opportunity.
They aren't exaggerating. This is the federal Grad PLUS reform. For context, for years, the federal government has essentially offered unlimited lending to graduate students with very little credit checking.
Right, which led to massive tuition inflation and a huge burden on the taxpayer.
You got it. And now the government is stepping back. The proposal essentially caps what the government will lend to graduate students.
Yeah.
This forces those borrowers into the private market.
And Sallie Mae's right there waiting.
Management estimates this creates a $5 billion annual origination opportunity for Sallie Mae.
$5 billion. To put that in context, that represents roughly 70% growth over their 2025 origination levels once it is fully phased in. That is an enormous windfall.
It is. The government is retreating, and Sallie Mae is standing there with a catcher's mitt.
Okay.
But, and the investors need to be clear on this, the timing is specific.
Right, it's not happening tomorrow.
No. They said it starts slowly in late 2026.
And ramps up from there.
Correct. It ramps up over 2 to 3 years. And this timing mismatch is what creates the bitter pill regarding the 2026 guidance.
Let's discuss that guidance, because if you just looked at the numbers without the story, it looks bad. They guided for 2026 EPS of $2.70 to $2.80.
Right.
They just finished 2025 with $3.46. That is a significant year-over-year decline.
It is. And the driver of that decline is a spike in expenses. Non-interest expense is guided to jump to somewhere between $750 and $780 million.
I dug into the breakdown of that spending. Management was very explicit that they are investing ahead of the policy changes.
They are.
About 20% of that increase is just standard inflation wages, rent, the usual. But 40% is designated for one-time investments like product enhancements and new credit models.
And the rest is marketing. Think about it. If there is a $5 billion wave of students suddenly looking for private loans because the government cut them off, you need to be the first brand they see.
You've got to be ready.
You have to spend the marketing dollars in 2026 to capture the customer who generates revenue in 2027 and beyond.
It's the classic J-curve effect. You take the hit on the P&L today to accelerate growth tomorrow.
Yes, exactly. Management predicted that if they execute this spend correctly, they see high teens to low 20s% EPS growth resuming in 2027. They are asking investors to accept a transition year, a construction zone, really, to get to that higher growth trajectory.
And judging by the stock price reaction, the market is giving them the benefit of the doubt. But we need to look at the risks.
Of course.
We've talked about the optical rise in delinquencies, but what about the actual credit quality? The 30-plus day delinquency rate did rise to 4%, up from 3.68% year over year.
It did. And while the denominator effect we discussed explains some of it, it doesn't explain all of it. However, Pete Graham, the CFO, made a very specific argument during the Q&A.
Okay.
He said the link between early delinquency and actual loan losses is diminishing.
That sounds like corporate spin, doesn't it? People are paying late, but don't worry about it.
It does sound like spin, but the data backs him up. Look at the net charge-offs or NCO.
Not real losses.
The real losses. These remain stable at 2.42%. If the rise in delinquencies was leading to defaults, the NCO number would be spiking. It isn't.
So people are missing a payment, stumbling a bit, but they aren't defaulting. They're catching back up.
Exactly. And they highlighted their loan modification programs. 75% of borrowers who modified their loans back in Q4 2023 are still current today. Right. The vast majority of these loans are co-signed. Even with interest rates higher than they were 3 years ago, parents are still signing on the dotted line. This signals that families still view the ROI of the degree as positive, and they have the capacity to pay.
So we have a company that crushed earnings, is aggressively buying back stock, pivoting to a capital-light model with KKR, and is staring down a $5 billion regulatory gift.
A gift, yeah.
But they have to spend a fortune in 2026 to get ready for it, causing a temporary dip in earnings.
That is the comprehensive summary. It's a story of short-term pain for long-term gain.
Which brings us to the segment where we stop being analysts and start being creative. It's time for This Is Not Financial Advice.
Disclaimer, we're just two voices on a podcast. Do your own diligence.
Exactly. But looking at this setup, I have a trade idea I want to pitch you. I'm calling it the sophomore slump arbitrage.
Okay, I like the title. What's the thesis?
The thesis is based on the inevitable impatience of the market. Right now, everyone is excited about the pivot. The stock is up. But fast forward to May or August of 2026.
Right.
Those high expenses we talked about, they're going to hit the income statement. EPS will look low. The optical delinquency rise from the loan sales will scare the retail tourists who don't understand the appendix math.
I see where you're going. You think the narrative will sour mid-year when the reality of the investment year actually bites?
Exactly. The stock might drift lower or stagnate as people get tired of waiting for 2027. That is the sophomore slump. The trade is to wait for that moment, maybe Q2 earnings, and then you don't buy the stock.
Okay.
You buy January 2028 call option.
You're leapfrogging the transition entirely.
You are bypassing the mess of 2026. You're positioning entirely for the EPS acceleration promise for 2027 when that $5 billion Grad PLUS wave actually hits the P&L. By buying the 2028 calls, you capture the leverage of the recovery without getting chopped up by the volatility of the transition year.
That is devilishly clever. It plays on the concept of valuation compression. During an investment year, multiples usually contract because earnings look bad.
Right.
You're waiting for that compression to buy the rights to the expansion year.
Exactly. You buy the harvest while everyone else is complaining about the cost of the fertilizer.
It makes sense. It requires patience, though. Most investors can't wait 2 years for a thesis to play out.
That's why it's an arbitrage. You're arbitraging time horizons.
I'll give you one alternative if we want to get really wild. A pair trade.
Let's hear it.
Long SLM, short, a traditional regional bank.
What's the logic there?
It's a structural bet.
Yeah.
Sallie Mae is becoming a capital-light originator with a massive federal policy tailwind. A traditional regional bank is stuck with high deposit costs, commercial real estate exposure, and absolutely no federal policy bailout coming their way.
I like that.
You go long the new model and short the old model.
You hedge out the interest rate risk and isolate the business model performance.
Exactly. But again, definitely not financial advice, just looking at the chessboard.
Indeed. So to wrap this up for our listeners, SLM beat big $1.12 EPS versus 95 cents expected. The stock is up because the market loves the $500 million buyback and the strategic pivot to private credit.
Correct. The evolve strategy is in play. But remember, 2026 is the construction zone. Expenses will be high, earnings will dip, and the accounting will be noisy.
But if they navigate it, 2027 targets high teens growth.
That's the prize.
I'll leave you with this final thought to mull over. The entire bull case rests on that $5 billion opportunity from the government changing the Grad PLUS rules. We know the proposal is out there, but we also know Washington. Do you believe the government will actually stick to the plan? Or, as we've seen so many times before, will the rules change again right when Sallie Mae is ready to catch the ball?
That is the $5 billion question.
Thanks for listening to The Deep Dive. We'll catch you on the next earnings print.
Stay curious, everyone.